these are kind of huge questions, especially if one thinks of how many trillions of dollars are involved in that. Understanding whether capital markets function efficiently and whether prices really reflect well the fundamental value of the underlying assets is important for many reasons. If, for example, markets are not well functioning, then it can be the case that companies that don't have good investment prospects get a lot of cash from investors and invest a lot in maybe a wasteful way just because their stock prices are high. And vice versa, it may be that some deserving companies don't get enough investments. In my recent research, I studied the implications of the rise in passive investing. Now, passive investing is essentially investing in a portfolio of stocks proportional to their value in the market index. Active investing, by contrast, is just investing in stocks in the way a manager thinks this company should be worth, and not necessarily according to their actual market capitalizations. For example, a manager may think that the company is overvalued by the market, and then they may not want to hold it at all. But a passive fund would hold it with a high weight because the company has a high market value. So, passive investing used to be about 1% of active and passive combined in the early 90s. Now, passive has overtaken active. And the question is, does this matter? Is it neutral for markets, just because essentially we're just following the actual market capitalization, or does it make a difference? So, what we show in our research is that passive investing is not neutral. Firms that benefit the most, whose prices rise the most, are the largest firms in the economy, and especially the firms that are overvalued. Now, why this is happening? And let me kind of give you a key kind of intuition, which is the key logic behind the findings. Think of a company, of a large company, let's say that is the favorite of some retail investors. For example, like Tesla was a few years ago, when people were very excited about the company, retail investors, and about its prospects, about what Elon Musk was saying. So, and Tesla had a bigger market capitalization than most of other car companies combined. And many people argue that at the time it was on the overvalued side. So, a company being overvalued, this means that many active investors are going to hold small positions in Tesla just because they understand that this company is trading well above its, let's say, true value, whatever that true value is. And then if there is a switch from these kind of investments, if people take their money away from these investments, from these active managers into passive, then there will be more demand for Tesla, just because passive is holding Tesla according to its market weight, and this will generate more demand for Tesla, will push its price up. And now when Tesla is worth more, it's also going to account for more variation in the market, for more movements in the market. And then these people who are holding Tesla with a smaller weight than in the market, they are going to start getting worried. They say, now Tesla is a big kind of part of our portfolio, it can cause lots of fluctuations. So if Tesla goes up even further, we're going to look bad to our investors because the market will have done better than us. So then they feel pressure to buy even more of Tesla. And this kind of creates an amplification loop that pushes these prices of large overvalued stocks up. So there is a lot of broad interest in these questions. This is first of all of interest to policymakers and regulators because there has been quite a bit of concern about the implications of this kind of seismic switch from active into passive, whether this is going to make markets less efficient. And we show in our research that there is an effect. The shift into passive can be damaging in some ways to market efficiency. Now, there are also other implications, and this concerns more the active management industry. So I think that what is really worthy of future research and can be very impactful is understanding more the incentives of asset managers, and also how one can structure these incentives in an optimal way, how one can find ways to induce asset managers to have a long horizon, take a long-term perspective, and express their information more into asset markets. Not about where the price of the company is going to be on the next month, but more about the prospects of the company in the next years.